Hey guys, welcome back to Fiscal Voyage. My name is Felix, and today's video we're going to talk about 3 dividend growth stocks for the month of December. All 3 of these stocks are good buying opportunities. I think you guys should definitely look into these 3 stocks and you're going to continue your research with them because I think they are great buying opportunity at today's market. Even though the market is very overvalued with a lot of the tech stocks and stuff, there's still great opportunities for you guys to buy great high quality dividend growth stocks for the month of December. But before we get started, if you're new to the channel, make sure to hit that subscribe button, and if you like to make money, hit that like button, as well as check out my free ebook in the description below. Alright, so the first dividend growth stock you see here, Lockheed Martin Corporation, ticker symbol LMT. I've talked about this stock in previous videos of mine. It's still flat since those videos, and I think it's very attractive price right now for December. 3 dividend growth stocks for the month of December. So right now, as of today, is down 2.42%. You can see here the dividend yield is great at 2.78, and if we look at the dividend history and the dividend yield, you can see here the company tends to average around 2.3. You can see here the 4-year average 2.3, and right now it's at 2.78, and this is as of Friday's closing price. So with the 2% down today, there's gonna probably be over 2.8%. And some other things of dividend metrics, 42% dividend payout ratio, excellent coverage there. 5-year growth rate of 10.4 and 18 years of dividend growth. So that's outstanding. And if we look at Morningstar, Morningstar gives it a 4-star out of 5. Some of the key ratios here, 8.18% revenue growth for the past 3 years. That's great, compounded annually. Net income compounded annually for the past 3 years at 6.39%. Return on equity, 147%. Excellent. The company is undervalued based on Morningstar analysts. Fair price at $433, and they currently at $374. Again, this is from Friday's closing price. So today they're down about 2.5%. You can see it has an economic moat of wide, which is excellent. You like to see this narrow or wide. You like to see companies with an actual moat. So overall, Lockheed Martin looking great. Some of the financial ratios here, debt to equity ratio is pretty high at 2.56, but they have outstanding interest coverage of 14.16. So overall solid. And if we look at some of the operating performance here from Morningstar, you can see here, return on investment capital over 20%, 30%, in some cases 43% there. So, and they average about 32% for the past 5 years. So it's excellent return on investment capital. And if we look at the fast graph for Lockheed Martin, you can see here the company has great history. Earnings has been steadily increasing year over year. There's been a few years, you can see here in 2011, it was down about 1%. And down in 2003 about 9%, negative 9%. But overall, solid performance, solid company, A- credit rating. So their balance sheet is outstanding. The earnings yield at 6.48 is not great. I like to see this 6.5 to 7% higher, but still, because of the fact that this is a high quality company, earnings yield at 6.48 is very acceptable. Yield at 2.78, again, with today's market that's being down over 2%, this is going to probably be over 2.8%. And if we put in the price, you can see here the company tends to follow the multiple of around 17 to almost 20 sometimes. And right now it has a multiple around 15.4, so it looks undervalued based on the historic PE multiple. So that's a good indicator that the company may be undervalued. And you can see here, with such a high quality company, reverting back to its mean of 17.4, maybe even 18 PE, you could have a total annual rate of return of over 16.2%. That's great for such a mature company like Lockheed Martin. So overall, I'm very excited about this company. I think it's a good buy opportunity in today's market. Make sure you do your research on that. So let's look at the second company. The second company to buy for December dividend growth stock is Intel Corporation, ticker symbol INTC. You can see here these big drops in prices were because quarterly report earnings. This was Q2 report and this is Q3 report. So they have some pretty, not so good earning release because of the new processors being delayed. So that definitely dropped the price, but because the drop price, that gives us opportunities. And you can see here, dividend yield at 2.78, so it's kind of like Lockheed Martin, but overall, very solid company. Earnings are expected to be about $4.89, and only a dividend rate of $1.32. So the coverage is very good. As you can see here, 26.9 or 27% dividend payout ratio. So that's excellent dividend payout ratio. The lower, the better. Gives the company more room to grow its dividend. They've been growing dividends at 6 years and at a nice rate of around 7% for the past 6 years. So that's outstanding growth record. You like to see dividend growth at least over the rate of inflation, about 3%. So this here at 7% is very nice. And we look at the yield history. You can see the 4-year yield average is about 2.6. And right now with the dividend yield at 2.78, it is up to date Intel, so this is going to be lower, maybe around 2.7 or so dividend yield, but still, nonetheless, it's still an attractive price. If we look at Morningstar, they give it a 5-star rating out of 5, so that's a buy rating from Morningstar. And some key ratios, the 3-year revenue growth at 6.6%, net income growth, you can see here 26.8%, 27% net income growth for the past 3 years is outstanding. That's a huge number there. Return on equity, 30% attractive return on equity. Economic moat is wide. You can see here Morningstar gives it a fair value price of $70. As of Friday's close, $47.45. Again, it's up about 1% today, but still very far off from the fair value price. Some key ratios here. Debt to equity ratio, outstanding 0.5. The balance sheet for Intel Corporation is outstanding. Interest coverage of 44 times. Outstanding. If we look at operating performance here, you can see here return on investment capital over 10%, sometimes 21%, 20%. And you can see here the 5-year average was 16, and the trailing 12 months is over 20%. So that's very attractive there. Price to earnings, 5-year average at 14.8. Currently, the PE is at 9.3. Price to book is attractive, and the price to cash flow is attractive. So these are good indicators that Intel is undervalued. And if we look at the fast graph for Intel, you can see here the company has this ups and downs in its earnings. There'll be years where it has a couple of years of negative growth. You can see here in 2012 and 2013, 11% and 11%. And in 2006, it was down 40%. And in 2008, negative 22% in earnings. However, in the long term, the big picture, earnings does grow. As you can see here, it's been growing at an annual rate of 4.7%. And this year, they're expected to be down about 6%. But still, because of that, it gives us a good buying opportunity, because you can see here, the discrete downs represents my buy. I'm actually right now, with the fact that it's up slightly today, I'm actually positive now. But it still gives you guys a good buying opportunity to get more shares, because you can see here, you can have an annual rate of return of about 18.6% if Intel was revert back to its mean of 13.5 PE, where right now it's at 9.7. So it's a very attractive price right now. Here again, A+ credit rating, 32% long-term debt to cap ratio. You like to see this at 50% or lower, so that beats that criteria. Earnings yield at 10.3. I like to see it 6.5%, 7% higher, and obviously at 10.3, that definitely beats that criteria. So overall, Intel Corp, very attractive price right now. I am a buyer here. Great projected total annual rate of return of 18.6, and while you wait until it gets to that price point, you could be collecting dividends, a growing dividend, while you wait for the price appreciation. Let's go to the third stock. So here's the third stock for the month of December. Walgreens, ticker symbol WBA. Walgreens, outstanding company. They've been growing dividends for over 40 years. Very profitable, and they still are expected to continue to grow. So let's go a little more, do a deep dive in Walgreens. You can see here they're down 2.19% for the day. But they have an outstanding yield of 4.79. So the fact that they're down 2%, they're going to hit it over 4.8, 4.2 or something like that. So that's very attractive, high dividend yield. Earnings is expected to be at $4.82 for fiscal year, and they have a dividend rate of 187. So with that, that gives us a dividend payout ratio of 38%. Very attractive dividend payout ratio, very low payout ratio, so that gives the company more room to grow the dividend. And you can see here they've been growing pretty nicely. 5-year growth rate of 6.58, 40 years of dividend growth, so they've been growing dividends longer than I've been alive. And overall solid company. If we look at the dividend yield, this shows right here how undervalued this company is. The 4-year yield average is 2.89, currently 4.79 dividend yield, so very attractive there. Morningstar gives it a 3-star rating because it's more or less fairly valued based on their estimates, but I think Walgreens should be around maybe $50, $60 company right now. But Morningstar gives it a $42 fair value price. It has a moat of a narrow, so it does have a moat. And some of the key ratios here: 3-year growth rate of 5.6. It's decent. It's not great like the other ones, but the net income has been negative. But I think that's just for the this year's, where it really affected that tremendously. And some of the key things here that I like: interest coverage is low at 2.16. Debt is pretty high at 1.95. But what I like about this company is the valuation. So some of the key metrics here, you can see here, price to earnings. This is, you avoid this because they do, Morningstar uses GAAP earnings per share. So they were doing a lot of things with Walgreens. But price to book, undervalued, and price to cash flow, undervalued based on the 5-year average. And then we look at fast graph. You can see here how undervalued this company looks like based on the fast graph. BBB credit, S&P credit rating, 57% long-term debt to cap. But this is what really drove the stock price down. You can see here they lost 21% earnings, but it drove the price way down. And what right now looks to be an attractive opportunity right now. So if we're showing this time period, you can see the market tends to value this company around 14 PE. If we shorten this, it's going to be around 12. And if it were to revert back to that, you can see here you can have a nice total annual return of 25.2% for the next few years. So that's outstanding. Plus the high dividend yield of 4.79. With the market down today, I can see this at over 4.82 or something like that. Earnings yield 12.2, outstanding. And one of the best things that so far that I like about this company is that they actually increased the dividend this year with the the virus and the shutdowns and things like that. So they were able to increase the dividend. So, and you can see here analysts are pretty accurate in estimating their earnings. You can see here 83% hit. So I'm pretty much confident with these estimates here. So I'm pretty confident with the total annual return, about 25% for the next few years. So I could definitely see that happening. All it takes is to have 1 or 2 good quarters, and this price will skyrocket because of that. So overall, Walgreens, the third company that I think is a good buying opportunity for this month. All right, so those are my 3 stocks for the month of December. I hope you guys enjoyed this video, and make sure to hit that like button if you like to make money and you enjoyed the video. And let me know in the comments below, what 3 stocks are you looking at for the month of December? What 3 stocks are you currently buying or you're very interested in? So let me know in the comments below, and I'll see you guys in the next one.